Hi, this is Sylvia from IFRSbox.com. Let's explore IAS 16 on property, plant and equipment together now. Property, plant and equipment are tangible assets that are held by the entity for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. In order to recognize the property, plant and equipment as an asset, both of the following conditions must be fulfilled. First, it must be probable that future economic benefits associated with the asset will flow to the enterprise. It means that the enterprise will receive rewards from usage of an asset, and on the other hand, it will carry risks associated with the asset, for example, repairs. Second, the cost of the asset must be reliably measurable. These two conditions apply for both initial costs and costs incurred after initial recognition or subsequent costs. Please be careful here because some assets do qualify for recognition as an asset, although do not bring future economic benefits directly, for example, water cleaning station and similar assets. These might be required by law for safety or environmental reasons to operate other assets, so shall be recognized as an asset. In relation to subsequent costs, some assets require regular major inspections, overhauling, replacement of major parts. All these shall be included in the carrying amount of an item, although incurred subsequently. Now, let's take a look how property, plant and equipment should be measured at its recognition. An item of property, plant and equipment qualifying for recognition shall be measured at its cost, which comprises of its purchase price. This price may include any import duties and non-refundable taxes, but shall be expressed net after deducting any rebates or discounts. Then, costs directly attributable to bringing the asset to the location and condition for its planned operation. These include, for example, site preparation costs, initial delivery and handling, professional fees, capitalized interest, testing, and similar items. Finally, the initial estimate of costs for dismantling and removing the asset or restoring the site where the asset is located, if the entity is obliged to do so. Typical example is nuclear power plant, where its owner has usually an obligation to decommission the power plant and restore the site after decommissioning. The cost of an item of property, plant and equipment is the cash price equivalent at the recognition date. So, if the payment for the asset is postponed to the later date, this amount shall be discounted, and the difference between present value of future payment and the cash price equivalent is the interest. If an item is acquired in exchange for other non-monetary asset, then it shall be initially measured at fair value. Now, let's take a look how the item of property, plant and equipment shall be treated after its recognition. That is, in the subsequent periods. IAS 16 prescribes two basic models. First one is cost model. Under this model, an item of property, plant and equipment shall be carried at its cost, less accumulated depreciation, less any accumulated impairment losses in line with IAS 36. The second model is Revaluation Model, where an item of property, plant and equipment is carried at its revalued amount, which is fair value at the date of revaluation, less any subsequent accumulated depreciation, less any subsequent accumulated impairment losses. Assets shall be revalued with sufficient regularity. Accounting treatment of revaluations depends on whether carrying amount of an asset is decreased or increased. When the carrying amount is increased, then this increase shall be credited to equity under the heading Revaluation Surplus. However, if the same asset was impaired before and impairment loss was recognized to profit or loss, increase in carrying amount shall be credited to income to the extent of reversal of such impairments. Decrease in carrying amount shall be debited to expenses in profit or loss. But analogically, if the asset was previously revalued to revaluation surplus, then the decrease in carrying amount shall be debited to equity to the extent of reversing such revaluation surplus. Now, let's talk about depreciation, as its principles enter into both cost and revaluation model. Depreciation is allocation of depreciable amount over its useful life on systematic basis. This definition contains three main parameters: depreciable amount, useful life, and systematic basis. Depreciable amount means how much we are going to depreciate, and under cost model, it's simply items cost less its residual value. Residual value is any amount that can be obtained from the asset at the end of its useful life, less estimated cost of disposal. Useful life is how long we are going to depreciate, and it's the period over which an asset is expected to be available for use by an entity, or the number of production units expected to be obtained from the asset by an entity. Thus, an asset might be depreciated based on time or based on units produced. Useful life depends on many factors such as expected wear and tear, legal or technical limits, and so on. The third element, systematic basis, means how or in what manner we are going to depreciate, and it's nothing else than selection of appropriate depreciation method, for example straight line, diminishing balance, or number of units. Useful life, residual value, and depreciation method should be reviewed at least at each financial year and seeking for any change. If there is a change, it shall be accounted for as a change in accounting estimate in line with IAS 8. It means prospectively with no restatement of previous periods. Depreciation shall be recognized as debit expenses and credit property, plant and equipment. However, sometimes the asset is used for production of other assets. In such a case, depreciation is debited to cost of another asset. Last topic to cover in this short video is the recognition of property, plant and equipment. Carrying amount of property, plant and equipment shall be recognized on disposal, that is on sale on entering into finance lease by the nation, or the asset shall also be recognized when no future economic benefits are expected from its use or disposal. When the item of property, plant and equipment is disposed, gain or loss may arise, which is calculated as net disposal proceeds, less any carrying amount of property, plant and equipment. Gains or losses from disposals of property, plant and equipment are included in profit or loss, but not as revenue. Rather, these are shown as a gain from sale of property, plant and equipment. If you like to learn more, please visit our website ifrsbox.com and subscribe to our newsletter. You can instantly download our free ebook Short Guide to IFRS and read lots of IFRS related articles. Thanks for watching.